Welcome back, investors. It's going to be an interesting week as earnings are now kicking off, and we're going to see if expectations are going to really meet reality here. And so when I look at what's reporting here, it's a lot of stocks that we've actually talked about on the channel throughout the year. And so SoFi is at the top of the list come Monday morning pre-market. SoFi is going to report earnings, and to me, this is kind of a really big earnings report for SoFi, as they're supposed to report basically break-even type earnings on $574 million of revenue. So if you're new to the channel, welcome in. This is obviously not financial advice. This is just my opinion for whatever it's worth, but SoFi is one that we've actually been pretty accurate on. And we originally saw SoFi dip into right around the low $4 range. And oddly enough, that is exactly where over the last few years, I've kind of had an earmarked price target between $4.50 to about $5.15. A lot of things to like about the growth trajectory on a company like SoFi and the one-stop shop platform that it does offer. But of course, there is concerns with this company, and that's why I'm not super bullish at these levels. So if you've been subscribed to the channel and you've been watching, you know that I wasn't a big proponent of this stock over $10, $12, $13 a share, but I thought it was pretty interesting in that $4 to $5 range. And as we saw by the chart, you would have had the opportunity to buy if you were subscribed to the channel and kind of thought through my thesis here. And no matter what chart you look on at SoFi, they are all impressive. No questions asked. This is a fast-growing company, and they seem to be doing things right. But when we dig underneath the surface, there's a diversification problem I really do have with this company. It reminds me of MPW a little bit. Now, I know MPW and SoFi are two separate industries, two separate sectors. One's real estate and one's banking. Well, the problem with MPW was it was a great company until one of their largest tenants stopped paying rent, and it turned it to a $20 stock down to a $3 stock. And when you look on the outskirts, it looked like a diversified business. They have many hospitals throughout the world, many different beds in many different sectors, and seem well diversified. But the problem was that one tenant carried a lot of weight. And I see the same kind of issue here with a company like SoFi. Now, it is an interesting company, and there are aspects that I really do like. And if it got back down to that $4 to $5 range, I would actually be interested. And I actually do have option calls here for their earnings report come Monday morning, because the market tends to really like what SoFi reports for earnings and then normally has a sell-off. So I do have some very cheap call options that could pay off a little bit here. So let's talk through some of the pros that I actually like about SoFi. Obviously, the use of the technology platform we can see here is starting to actually pay off fairly well. But the one that actually makes me most excited about SoFi's platform is the growth that they've had in financial services, because financial services is one of those things where you don't have to worry about people defaulting. This is kind of like easy money, assets under management, and it's a nice perk to have good financial services, and they're actually coming out with some pretty innovative ETFs overall that I think could actually catch on and be a big part of what they're about. So with that being said, those are the pros that I actually like about SoFi's platform. Now, here's some question marks or valuations that I definitely have a problem with. Let's first start out with the tangible book, and that's how we kind of look at a bank, is based on the tangible book value of the bank. And normally you're seeing companies trade at 1x book, or sometimes even below 1x book, depending on the quality of personnel and what kind of financial services these banks offer. Tangible book value for SoFi right now is at $3.2 billion. But when we scroll down to see what the market cap is for SoFi, sitting at $7.3 billion is extremely rich when we look at the valuation here. And so I definitely still lean on my analysis of $4 to $5 stock, especially if you're looking for a specific rate of return here. If you're not looking for any sort of rate of return or any sort of growth factors, maybe you can justify jumping in at these levels if you can think the company sustains growth and the book value is going to grow astronomically, and it definitely has the possibilities and capabilities of doing that. The problem I have with the overall valuation is not that it's just high, but how the company's positioned, as we stated before, very similar to MPW. When we look at diversification, this is the red flag I have with SoFi. It's pretty clear to see that personal loans make up a majority of their loan origination here, and that becomes a pretty big red flag to me personally. And the reason being is personal loans don't have any sort of collateral or any sort of securitization that comes along with it. And if we go through a softening in the economy, SoFi is one of those companies that could actually get hammered pretty hard here. Now, a lot of their loans they try to sell and package up, but we can see here that unpaid principals right now are sitting at $14.8 billion. billion. And when we look at total principal here of fair market loans, we're sitting at nearly $21 billion. Of course, the company is growing extremely fast and they are heading on a great direction. The problem becomes if there's any sort of softness or layoffs coming in the market, this is a company that we can see their stock price get hammered very, very quick. We top of that with the book value of the company versus where it's trading. It's trading for a substantial premium, and a bank like this probably shouldn't be trading for that much of a premium. Yes, you're going to pay for that growth aspect and what the future could look like for SoFi, but then you also have to remember the downside risk of uncertainty and defaults coming. If we do go into some sort of slowdown, or if there is a substantial amount of layoffs, this could be a big problem. Now, the bull case for a lot of people on SoFi is that the qualified people that take out these loans are some of the best qualifications you can ask for, with great credit scores and tremendous work track records. That sounds good and all, but when we look at where the layoffs are actually coming from, they're coming from the tech sector, which actually knocks on a lot of those qualifications. People that make six figures or more and usually are pretty sophisticated with their finances work in the tech sector. And so just throwing it out there, I'm not trying to create any drama, but these are the pros and cons I see with SoFi, and this is the first company up, which I do think they're going to report strong earnings. That's not the problem. The problem is if there's a softening and how they're diversified within their business model is the concerning part for me on SoFi. The next company I'm personally interested in is actually going to be Pfizer here. This is starting to be built out as one of my larger positions in my portfolio, and this is what we call a turnaround story. When I look at Pfizer, to me, this is a $20 to $24 stock. And yes, I've been averaging in right around $27 a share. And that's about where my cost basis is. I'm pretty conservative on my projections with Pfizer. And my overall optimism is that they have been making acquisitions and building out their pipeline. And it's only a matter of time before these things start coming to fruition. We get multiple expansion and we get price discovery. Now, of course, these things could absolutely not happen. But when I look at the pedigree of a company like Pfizer, this was one of the most important companies. I do believe Pfizer has the ability to regain itself as one of the top pharmaceutical companies in the world. I also believe they're doing everything they can with mergers and acquisitions, research and development, to eventually build out their pipeline for the next 5+ years out. On the earnings call, I'm not necessarily concerned about what they're going to produce. It's basically been a kitchen sink few last quarters, and they've thrown everything at the investor, and the stock's done nothing but sell off from over $50 a share down to $25, $26 a share, cut in half. So when I look at Pfizer, I'm not necessarily worried about this quarter. What I want to hear on their conference call is optimism of their pipeline being built out and some of the exciting remedies that could be coming around the corner in the next 3, 5, 10 years out. Right now, this is a really hard one to put a valuation on. It's definitely been beaten up, left for dead. And along with this one is obviously Bristol Myers Squibb. But the big market movers are just around the corner. As Tuesday, after the close, we have AMD, Microsoft, and Google reporting earnings. Of course, Starbucks is a big one as well. This is going to be a big step here because we know AMD has been running up with the chip makers and NVIDIA breaking out of new highs and becoming the AI dominance of the chip makers. But AMD is riding on the coattails of this. And we're going to find out if this valuation is supportive of what they can project out on earnings. When we look at the S&P 500, really dominated by the triple Qs and technology, the S&P 500 is not what we used to think it was. It really is the triple Qs, and most of the weight is going to be on Microsoft, Google, and these are going to be massive market movers. We know Microsoft has been running away with the whole AI thesis along with NVIDIA, but these names have actually been moving the market. And when do we normally get separation from all of this? Is during earnings. We're going to get a separation of quality versus quantity. AMD versus NVIDIA, is it justified? We're going to find out during earnings. Is there going to be a separation taking place? Microsoft and Google, is there going to be a separation taking place? Because all these stocks have been moving in an upward direction and might be rightfully so, but we don't know until we get the earnings calls going. So after Tuesday after close, 2 days later, we have Amazon, Apple, and Meta all reporting earnings as well. This is a massive, massive week when it comes down to earnings and understanding what exactly we own and what kind of trajectories these companies are on when we talk about the whole AI movement and technology movement that's taking place and the euphoric behavior that's in this market. The most interesting one to me, believe it or not, is going to be Apple here. And the reason being is Apple has been kind of stagnant over the last few quarters, not showing a tremendous amount of growth. And where they've been getting growth through EPS has been share buybacks. So it's going to be interesting to see how are they handling the China situation. Are iPhone sales and product sales still strong? Do they have anything in the pipeline when it comes down to AI where they can start competing with a lot of the bigger mega tech companies as well? So there's a lot of question marks around Apple, and yet the stock has been going up. And valuation has been going up on low growth and not really much coming through on the pipeline. So this is going to be another interesting one to kind of watch. Are we going to see a reversal of conditions in this market? Because as we looked at the technicals, I thought that we could see a possible reversal here soon, that this move up has been exacerbated and that March could be actually a choppy month for the markets. As always, really appreciate your time and we will see you in the next one.